There's a broader macroeconomic story playing out for the US dollar and some of the other major currencies, especially the euro. And then there are some immediate issues which are driving markets, and I would include geopolitical tensions on that list, as well as, of course, the immediate decisions that the Fed needs to make around the March FOMC meeting. So I think we can kind of look at the dollar in those two ways. We think that that broader macroeconomic story probably points to moderate dollar weakness over the course of this year, basically because there's a lot of action priced in for the Fed, and we think that the global economy will perform fairly well. That combination, we think, can give us moderate dollar weakness. But as you say, there's also some immediate things, including geopolitical tensions, that are getting in the way of some of those macroeconomic themes playing out.
Yeah, we need to talk about them a little bit more. What if we do have Russian tanks rolling into Ukraine? What if oil does hit $100 a barrel with consumer prices, sticker prices, the highest we've seen since Reagan, 40 years? I mean, that's got to force the Fed's hand, no?
The Fed is definitely focused on bringing inflation down first and foremost. I think that's pretty clear that they're at the beginning of a steady rate tightening process. And if we were to get more inflationary impulses at the moment, those probably would, in today's environment, emphasize more tightening rather than an easing back. So I do think the inflation concerns will dominate for the time being. Now, if you were to see signs that the economy was starting to slow down or a big tightening in financial conditions, then that could be a reason for the Fed to take a break. But I think you're right. Higher oil prices probably do speed up the tightening process if we were to get there.
Zach, we're here in Singapore as well. I just wanted to ask you about one function of the Fed in terms of this tightening strategy, and that is, of course, the balance sheet. There isn't necessarily all too much clarity as to how they're going to be engaging that. Perhaps we'll get some clarity in the minutes later on this week. But in terms of the impact that the runoff will have when it's aligned with the withdrawal of fiscal stimulus and the rate hikes that even Goldman pegging those 7 hikes that come in 2022, doesn't that bode well for US dollar strength as all of this liquidity gets removed from the system?
I think we need to keep in mind a couple of things. The first is that there's a lot of tightening already priced in. The market is aware that we are on the cusp of a pretty meaningful period of Fed tightening. And we now have a decent probability priced in that the Fed goes by 50 basis points just next month. So, I think that that's really the key distinction here. The Fed is definitely going to tighten. Is the market discounting too much or too little? And I would argue that maybe market pricing is a bit full. We will see. There are some immediate decisions around the March meeting coming up, and a lot is up to communication over the coming weeks. But if the Fed delivers, say 3 hikes by June, that'll be a mildly dovish surprise given what's priced in. So I think we need to think about the dollar in that context.